complicated tax returns, and yes, I do simple tax returns. Every now and then when somebody walks through a door with just a W-2, I get excited about that also. Todd, I really do. I want to welcome all of those of you tuning in this morning, those of you listening to me, Northland Cable Channel 5 subscribers, those of you watching us live stream here in the Blue Room, www.WCAB59.com. Good morning. Good morning. My engineer this morning, Todd. Good morning, Todd. I had Lou here, I had Jay here, and now I have you. I think I've gone through the whole gamut. Now, we were supposed to be live this morning down at the fountain, but we're not, but we are live here. We are live here. I am an enrolled agent, and as an enrolled agent, I can talk about ground leases, Todd, with authority. Let me tell you why I'm so excited about ground leases. Wait, first, the program is live. You can call here at the studio, leave Todd a message. You can call me on my cell phone, 828-289-9300. You can now try to answer your questions live on the air. I can't guarantee I can get to them. I think people sit around and think of tough questions to ask me, Todd. I really do, because I get some questions that I have to go back and look up. But I will try to answer them live on the air if I can. You can send me an email, gilbert@gilbertcarmona.com. That is Gilbert @GilbertCarmona.com. I have an office right here at 113 Whitesides Road, right up the street from the studio, right next to Southern Baptist Church. I have another office in Polk County in Tryon, the beautiful Art Deco building at 226 South Trade Street. Now, the best thing to do is you can call me for an appointment. If you have a question, send me an email. That's really the best way. And I appreciate all the questions and all the people that have come to see me. I want to thank all of you, especially from this program. You know, we started doing this program just to get education out there. As an enrolled agent, I really do research this. I take taxes very seriously. I spend a lot of time reading about taxes, much to my wife's dismay. A good evening for me is to just crack open that IRS code book and just, Todd, it doesn't get more exciting than that. And read about some things. But I take it very seriously. It's not just about money. It's really about people's lives. Because as I've said many times before, taxes affect so many decisions we make. It affects our investments. It affects our business, what business decisions. It affects what neighborhoods we buy houses in. And what's one of the questions people ask? What are the taxes on that house? We can afford the house, but can we afford the taxes? So I take this very serious. I'm going to talk today about several things, not just ground leases, although I could probably do an 8-hour program on ground leases. But what I talk about is really just what happens in my practice every week. And that's really what I bring here to the table. As I shared that scripture last week, Paul said, I can only give you what I have. What I have is what I give. And I don't really work up things to talk about for this program. I just think about, what did I do this week? What kind of issues did I come across? What kind of problems did I face? What kind of questions did the people have? Something I've seen happen, so I'm going to get right into it, Todd, because something this exciting just can't wait. It really can't. Todd's looking it up right now. Interesting, isn't it? Todd's just, he's, I'll answer all your questions. Don't you worry about a thing. What I see happen this time of the year specifically is people will come in and they will have entered into a contract, into a lease. They own, typically, it works like this. They own a piece of land out in the middle of nowhere, as far as they're concerned, out in the middle of nowhere, that they inherited, usually from a relative that they didn't know very well, or just a piece of land that got passed down through the generations. They may be the third generation recipient of it, or they'll have an interest in the land, meaning 2 or 3 family members. I've seen where it's 2 or 3 family members that don't even know each other. They're distant family members will have an interest in this land. And somebody will come along and somebody will say, you know that piece of land you got there on the side of the mountain? I think that would be a really good place for a microwave telephone tower, or a cell phone tower, or I want to build a tower that they then in turn rent the tower out to people who pay them to attach things to this tower. What those things are, it could be anything. Microwave transponders, internet bouncers, am I pronouncing that right? People back before we had got all the infrastructure we have now, the only way to get internet in some of these hills and hollers, especially up when you get up towards Virginia, the only way to do that was to build these towers and just bounce a signal around back and forth, and hope that people could catch on to it and they pay a subscription, and it was pretty profitable to do that. Now, of course, as we lay more and more wire down, especially fiber optics that they're laying down, we don't need this anymore, but it's still a way to set this up, especially with the cell phone towers. So they'll come and they'll say, I want to put a cell phone tower up. Well, these things cost a lot of money to put up. And one of my clients actually has a business where he climbs these towers and installs this equipment. And he makes a lot of money because it's very dangerous work. And the insurance is unbelievable what he pays. So yeah, they pay him a lot of money to get one of them pieces of equipment up there, and them things weigh 300, 400, 500 pounds. It's not like you can just carry it up there and bolt it down. And recently in the news, there was a story of a person that had a fatality, a company that had a fatality. Now, I didn't know that company, but people in the industry that are clients of mine knew them, and it was a tragedy. It was actually equipment malfunction. It wasn't installer error, which is usually the problem. So they come and they tell you, we want to put this tower up, and they're going to put a lot of money into putting this tower up. So they're going to want to lease this from you, and they want this lease to be very long, very, very long. A 25, 30, 50, 99-year lease is not uncommon. There are actually even 500-year leases. Not so much here in the United States, we haven't had that many, but in Europe and in Asia, especially in Japan, there are people that will actually enter into a 500-year lease. And that seems, to Americans, that seems like a very long time, but don't forget, in Europe, there are families that can approve land ownership back 1,000 years. The same people have had the same pieces of land 800-900 years. That's not that uncommon. I've actually met people that live on family land that their family has had for 400 and 500 and 600 years in Europe, Scotland, Ireland, places like that. Now, I've never met anybody, but I've heard from my clients that do business in Japan that Japan has similar arrangements like that. So you enter into this lease. Typically around here, what I see is a 50-year lease. A 7-year lease. I've seen 7-year leases. I've seen 9-year leases. I've seen 50-year leases. These are called ground leases. Another word for them is perpetual easements, where you're not giving them all the land, and even in a ground lease, you're not giving them all the land. You're just giving them a lease on a part of the land. Now, if you only own a small piece of land, they may want the whole thing. I mean, it just depends. But typically when people own these kind of tracts of land, they typically own multiple acres. You're not going to own a quarter acre on the side of a mountain surrounded by 500 acres. It's usually you're going to own a chunk of it, because people bought this stuff when it was cheap or it was given to them. I mean, we're not that many generations removed from some of these land grabs, when land grabs were allowed. We think this is ancient history. It wasn't. I mean, what was it, 3-4 generations ago we had land grabs. When did North Carolina become a state? We were having this discussion the other day. Because I mean, the Oklahoma land grab, I've actually had, I don't have them anymore, they moved, but I had a client who actually had Oklahoma land that their ancestor, like a recent ancestor, a great-grandfather, 1789. That really wasn't that long ago. 1,000-year history. You think of Europe's history, the 8th century, the 9th century, that wasn't that long ago. So I had a person that actually had Oklahoma land that their I'm pretty sure it was their great-grandfather, might have been a great-uncle, but got this land from the land grab, when we call it a land grab, when the government said, you go out there, you put 4 stakes in the ground, connect the dots, and that land is yours. Unless it's somebody else's four stakes, and they talked about having 10,000 acres, but you can't put that much cattle on 10,000 acres out there. It's sparse land, and the grass grows few and far between. So you needed that much land to do anything with it, and it was really not worth very much. I mean, we still have that in Utah, Nevada, places like that, but in Oklahoma is another example of a ground lease state. There, instead of cell phone towers and some of this other infrastructure we have here, and it'll be mineral rights. They'll want to lease your land to pull minerals out of it, whatever those minerals are, whether it's oil, shale, iron. I mean, it can be anything, copper, and usually these things are all byproducts of other mining. But carbon dioxide, I mean, that stuff, it comes out of the ground as a gas, and the stuff that makes your drink fizzy at the gas station, that is the byproduct of mining, and it actually has a value. So you enter into these leases, whether it's a 7-year lease or whatever, a 50-year lease, and this is where the tax part comes in. So they offer you, just to use round numbers, because I've seen everything from $5,000 to $500,000. They offer you $100,000 for a 25-year lease on a piece of land. That is a contract. You've got 2 things to realize. 2 things. Number one, that money is taxable the minute you get it. You can't defer that money. You can't say, well, it's a 25-year lease, I want to divide that by 25 and pay my... No. You get that money, it's taxable right then and there. And what I see happen I've seen it happen with the Texas oil people who lease land for oil rights. I've seen it with the Oklahoma oil people. I've seen it with the mineral people, the coal people, and the cell phone tower people. What they will do is they will give you that money the last day of the year, because they've been using this money all year for their things, and then they will have this pool of money. And a lot of times it'll be an option that they're going to exercise. Do we want it? Don't we want it? And it's their option. Then what they'll do is, I've had people come and say, the money showed up in my bank December 31st. Now, back in the day when they would send a check, we would get into all kinds of interesting conversations with the IRS, because the people leasing the land would write the check December 31st, put it in the mail. Technically, that is good. They can write it off in that year. Now, the people getting it in the mail might not get it till the 3rd or the 4th or the 5th, depending on how backed up the mail is. Especially, you still have holiday backups and you still have issues and you have bad weather and this, that. So they got it. They'll say, hey, wait a minute, I didn't get that check until 2017. And they don't have to declare that income until 2017. Now they'll get a 1099 from this company telling them, no, we gave you $100,000 2016. And I tell them, and so we get into these conversations, and it's like, well, does it really matter? You've got to, right? You're going to pay taxes on it. You pay it in 16 or 17, unless there's a real compelling reason why we want to move it a year and get into this whole discussion with the IRS, because they will call you on it. Especially when the number's that big, they'll want an explanation. Or I need to attach an explanation with the tax return. Yes, we got a 1099 from last year, but we didn't receive it. And then you send them bank deposits and bank statements and stuff to prove that's when you got the money, and whatever else you can send with it. But now, in the day of wire and electronic transfer, that money will just show up in your happy bank account. And it'll be happy because it's $500,000 or $100,000 or $200,000 or $50,000 richer. And then what do people do when they get that kind of money, Todd? When they get $200,000, $100,000?
Go buy more guns.
What does they do? Go buy more guns. No, Todd, that's not, well, they might. They might. Or They roofed the double wide. New tires on the truck.
Spurs for the chicken.
Spurs for the chicken, says Todd. That wasn't on my list, but I could see it. Sure. New tires on the car. New ring for the wife. So after you spend all that money, and you spend some more, and you spend some more, then you're going to go see Gilbert. You're going to go knock on Gilbert's door. And Gilbert is going to tell you that you now owe 25% of that money to the government. Because the IRS is going to want anywhere from 15 to 18% of it. And let's not forget our friends in Raleigh, who are going to want 5.75% of that money. So just be aware, you owe it in the time you receive it. And because these leases, they're called ground leases, perpetual easements. Okay, what is the key word there? Ground. What is it about ground? Land. You cannot depreciate it. So you have no expenses, no expenses at all to write off against that money. Now with mineral rights, when they're mining or taking oil out of the ground, which we don't see that much of that around here anymore. But let me get back to it. With depletion, you can get a write-off for depletion. And that typically there will be engineers involved, and they will let you know how many metric tons they pulled out, or tons, as they say, how many tons they've pulled out, and the value of those tons, and that reduces the value of that land. Again, though, you're just, one thing's washing out the other, you've still got to pay the tax on that money when it comes. And that's the point of all of this, is I want to make you aware, because I've actually had several people that it's a big happy thought, they got this money, and they know they're going to owe some tax, but then they're shocked at how much tax it actually is. And I've had enough of this that I wanted to talk about it. I actually found a book, Todd, called Ground Leases in the 15th edition. 600 pages of it. Now, my wife would not let me get the $2,200 double set hardback college edition. She just thought that was a little much. I had no problem. So I got the $19 paperback. But I can't wait to get it. I ordered it yesterday. 600 pages on ground leases and commercial. You can come over. I'll let you read it. Yeah, I know. Todd can't wait to read that. But, but it's important because you enter into these things and there is a huge implication. Then we're going to take a break here in a minute. I could talk all hour about this. The other implication is you got to remember, especially us older folks that are hoping to leave an inheritance. I mean, I'm thinking now, I'm at the point right now in my life where I'm thinking about my assets and what I'm going to do with them and where they're going to go, setting up a trust and I mean, I've got a granddaughter and I've got charities and I've got, 501c3s and just different things, and my wife and my estate, and you start thinking about these things. Well, you have now encumbered is the legal word for it. You've now encumbered that land, and you need to let the next generation know that, or whoever. Of course, if they try to sell it, they'll find out real quick, because that lease will be recorded at the courthouse. The people will make sure of it. And the other issue, too, you want to make sure if you get approached by one of these. Now, the people that will approach you with this kind of arrangement, or if you reach out to somebody about this, they're professional. They're not going to give you $200,000 without them knowing what they're getting into. So they'll address a lot of these issues on the front end, and they'll give you a contract. I'm shocked at how many people don't read those contracts, or at least bring them to me or take them somewhere and have somebody read them. Because I'll say, did you have a lawyer look at this? No. Did you have an accountant look at this? No. Did you look at this? No. All we knew was we were getting a check. Just give us the check. Just give us the check. That's what they say. And but the taxes on the land, who's going to pay the taxes? The people leasing, typically in an easement situation or in a complete ground lease, They'll take care of the taxes. It depends. It's whatever. It's all negotiable. That's the thing. It's all negotiable. Of course, if they can give you $100,000, $200,000, whatever, $1,000 and pay the taxes on top of it for as long as they have that lease, that would be wonderful. That really would be. That would be just absolutely great. If you still have, for whatever reason, a mortgage on this land or part of this land, or this land is part of a homestead that you may have used as collateral for something else, check with your bank to make sure you can even do this. You don't want to enter into a contract, get the money. Now, they'll probably have researched it first, so this probably wouldn't happen, but anything is possible, my friends. You don't want to get that money and then find out you got to give it back, or you got to pay a penalty to the bank for leasing what you thought was your land, which is really not your land. If you owe the bank money, it's their land. So those are just a couple of the things I wanted to get out with these leases, is some of those issues involved with them. There was one other topic too about it. The insurance, the taxes, make sure. This is important. Okay, and I'll finish with this. We'll take a break. Well, several of the people that have come to me had the problem. It's almost the same identical story. The people talked to them, gave them the contract, they signed the contract, said you're going to be getting your money. December 31st, the money shows up in their bank. Or they get a check in the mail January 2nd, but the check is dated December 31st. Okay, fine. I asked them, and what happens is, in all 4 scenarios that I've had with these kind of leases, what happens is it takes your tax bracket way up. Where normally you were, 2 W-2, husband, wife, 2 W-2, couple of children, some dependents, you had your things, you had your house, you had your few write-offs, or you might have had a small business, whatever. You were in a 15% tax bracket. You were in a marginal tax rate of, 10.5% or something. Well, now you're in an 18.58% marginal rate. You're in a 25% tax bracket, because your income just went up by $200,000. You blew past that $188,000. And you ain't looking back. Okay? And it's just in that year. What I had, now years ago, I haven't had this recently, but years ago there was a man, he had Texas natural gas land. They had already taken all the oil out of this land many years ago, and they were grazing it, but there was still natural gas deposits. They usually run together. Natural gas deposits on this land. And back in the day, there was too much water in it to get it out. So you get it all here, Todd. You get taxes, you get engineering, metallurgy, you get it all. You learn everything here. There was too much water in the ground to pull the natural gas out efficiently. Well, they've gotten some breakthroughs with technology, and they talked to this man, a good friend of mine in Polk County, and they contacted him and they said, we know we tried to get gas out of that land 10, 15 years ago. The gas is there, natural gas is there, a lot of water, but we've got some new techniques we'd like to try. We want a 7-year lease. We're willing to give you $300,000 to try. Now, if they pull natural gas out of there, it's worth millions and millions and millions of dollars. So these guys, they're called wildcatters. They have no problem putting down this kind of money. So he called me because, of course, he wanted the money, but what would it do to his tax bracket? He had other investments. He was already in a high tax bracket. So I crunched some numbers, and I said, ask them if they'll split that. Ask them if they'll go 3 years, 3 $100,000 payments. Well, they came back and said no, but they would go 2 payments, $150,000 each. But they wanted it off their plate because they wanted to pay that money. So what we did is we timed the payment December 31st. Actually, we ended up negotiating a little back and forth. We let them do $200,000 December 31st and another $100,000 January 1st. That way they got it off their plate, leases were locked in, and they paid the money and he was able to defer the $100,000 into the next year. Now, in his case, that did help because I kept that below a certain tax bracket for that time. Now, the new tax brackets have changed that, so don't use that. Don't use those numbers in your tax planning, okay? That's a scenario. But so that's what I wanted to get out. These things have a tax implication. Don't just be all excited about the money, start shouting the hallelujahs and go spend it. There is a tax implication. There's a legal implication. You're locking this land down. So, and there's enough of it happening in this county. And if gold, I thought with gold prices and silver prices started to shoot up, I thought we were going to see more mining again, but now it's been depressed. Gold and silver have come down again. Palladium, rhodium, some of the things that we find around here, they're down. So I don't know what's going to happen there. Todd, I think I've really, I know I can keep talking.
You can take 2 breaks.
I blew right through the break. Look at that. Right through it. Let's go ahead and let's take a break. This is Gilbert Talks Taxes, among other things, right here, WCAB 590 AM.
What can I say about Cafe at the Mall, Cafe to Go, and 10 North Trade Cafe Bakery that can do them justice? The cakes, fresh baked breads, sandwiches, and salads, everything is delicious and perfect. Whether it's sit-down dining, lunch on the run, or catering for any occasion, Cafe at the Mall, Cafe to Go, or 10 North Trade Cafe Bakery is the place to go. Stop in at Cafe at the Mall, Cafe to Go, and 10 North Trade Cafe Bakery and mention Gilbert Talks Taxes and get a free cranberry oatmeal cookie, the official cookie of Gilbert Talks Taxes.
I get asked all the time, Gilbert, with 2017 already here, will your hair continue to look as fabulous as it looked in 2016? The answer is yes. How can I say that so confidently? Because I go to Robin at RSL Salon. Call Robin for an appointment, 289-9110, or call Emily at 447-3524. Whether it's hairstyling, manicures, or pedicures, it's always RSL Salon because everyone deserves to look fabulous. I want to tell you about a little-known Rutherford County gem, Integrity Marble and Granite, located at 287 Shiloh Road in Forest City. They are the premier stone fabrication company in the western North Carolina region. They specialize in granite, marble, and natural stone, offering complete design and installation. Their design center and Kohler showroom features vanities, decorative accessories, bathroom, and kitchen fixtures. You do not have to go to Charlotte or Asheville for this kind of quality. We have it right here in Forest City. Stop in their showroom and browse their beautiful displays, or you can call 828-247-8801 for a free quote. You can also go to their website, www.integritymarblegranite.com, and look at the pictures and see samples of their available materials. Now, mention you heard it on Gilbert Talks Taxes, and they will give you $100 off any sink purchase. That's Integrity Marble and Granite. This is Gilbert Talks Taxes, right here, WCAB 590 AM. We're back because taxation, as we all know, Todd, taxation with representation has not been such a good idea either. Thank you for the phone calls, and I'm getting some texts, but I don't even know where my phone is right now. I put it right now. I got a question, but I'm going to wait to answer that question. I want to talk about one thing here. I'm going to take a real short segment to get back on track with our breaks. Oh, look at this. People are very excited about that. Got a couple of texts on it. Okay, about ground leases. I can't wait to get the book. It would be, maybe I should write my own book.
You probably could.
Probably could, on ground leases. So, and perpetual easements. That is really what is fascinating. I'm going to talk real quick about something else I'm seeing. And I've only had one this year, but I want to reiterate this point. Iterate and reiterate. If I had a lady come, she went to another tax preparation place. She had a baby in November, and this preparer told her that the child had to be in the house for 6 months, longer than 6 months, and she didn't qualify for earned income tax credit. Yeah, even Todd knows this one. He's nodding his head no. Well, the lady knew She said, that doesn't seem right. What do you mean? The baby was born in November. And the tax preparer was emphatic about this. Oh, no, 6 months. Well, that's letter of the law. And this lady really, I spoke to an IRS agent about this, and the man said, it would just seem like common sense. I said, no, you got to put it in the rule, but you got to spell that out in the code. Believe me, people don't know. The only exception to that 6-month rule is date of birth, date of death. Okay, and in the case of a kidnapped child, which, kidnapped child does qualify as a dependent that year, which there's actually a whole thing in the tax code about that. Kidnapped child, it happens a lot. Most of these kidnapped children are non-custodial parent related, and the child usually turns up many years later. Sometimes it just depends. Most of them are not heinous crime type of a thing. It's usually where a parent takes the child. A lot of them are foreigners. They flee the country with the child. Things like that happen. But so the year of birth, if that child is born December 31st, you can claim that child as a dependent the entire year. So just everybody know that. And believe it or not, there are tax preparers out there that are saying the opposite. I've had this happen. I had it happen several years ago, and now I'm seeing it again. And it's usually new preparers that go to preparer school and read this rule and interpret it that way. And because the software doesn't address it specifically that way, they go with it. Fortunately, the lady said this doesn't feel right. There were a few other issues too that she wasn't sure about, and somebody told her, you need to go see Gilbert. And so she made an appointment and came in, and I fixed her right up. I remember my girl with the twins. This was a few years ago. She was having twins. Her due date was December 29th. And I tell you what, I was at home sweating that one out. They were born December 22nd, and I told her, I said, it was a little too close for comfort there. But she had a double write-off, earned income tax credit and child tax credit right there at one time. But it counts for the whole year. Now, Todd, let's go ahead and take that. Well, let me answer this question. Auctions. Somebody just called here about an auction. Personal auctions, you're downsizing. Is that taxable income? The answer is, if you're selling personal items that you're just selling, no, that is not taxed at income. Now, if you have collectibles that you made money on, you can get into the whole issue of a gain, especially like artwork, antique furniture. I can go on and on. Antique cars, this kind of stuff. If you have a gain at it. Now, if you're dealing with a reputable auctioneer, auction house, if you're dealing with a firm, they'll advise you on this and they'll discuss all your tax implications with you. But if you're just selling your stuff that you've owned and you've bought, you've used, and you're selling it usually for a fraction of what you paid for it, no. You don't have to pay tax on this stuff. You're not doing this as a business. You're just downsizing. And one thing, and I've talked about this before, you may want to consider donating. Because donating, it just depends on your tax bracket, and if you're going to meet Schedule A, there's a lot of things to look at. But donating, and I'm not doing a plug for any one charity, okay, but donating is a good way. If you make Schedule A and you've got a lot of quote unquote stuff, the trick to donating though is get an inventory of everything you donate and get a real thrift store price. What I see happen too often is a typical example. I've got 6 of them this year. 7, actually. Parent passes away. A house full of stuff that nobody wants. And I don't mean that in a bad way, just the heirs don't want it. They got enough for their own stuff. And it's stuff, linens and just things that nobody wants. They'll throw it in bags, take it down to pick a place, Goodwill, Hospice, Yoke Fellow, whatever. Take it to one of these places, St. Luke's thrift shop, whatever. Take it to a charity. The Catholic Church, the Seventh-day Adventist Church, all of them have these shops. Okay, so they take it down there, and the person says, "What's it worth?" $50. And they get a slip and $50. When really the value of the stuff that's in there is more like thousands of dollars, even thrift store prices. Turn around and see what they sell that stuff for. what they sell it for. Oh yeah. And when hospice comes, hospice will even come, I know others will too. Again, I'm not doing a plug for a charity. They'll send a truck over, and they'll fill that truck up. I would argue that if you took a little bit of time and did an inventory, I'm not talking about a complete inventory, every washcloth, but break it down a little and look at it. I would argue that in a house like that, you're giving away $6,000, $7,000, $8,000, $9,000 worth of stuff. And as long as it's legitimate and you've got pay back up, and somebody from the charity will sign off on this inventory, you can put it on and you make Schedule A. That's the key. Will this help you? That may be a thing for you to look at. Don't just dismiss this stuff, throw it in the bag and say, it's worth $50. I see that way too much. So to answer your questions, auction, taxable, no. Collectibles, yes. The gain on collectibles. Okay, Todd, let's take that break. This is Gilbert Talks Taxes, WCAB 590 AM.
Hi there, this is Kimberly, and I'm here to tell you about Peterson's Auto Service and Detail Shop. As a woman, I'm often apprehensive about taking my car to a dirty service garage. But you can be assured that Peterson's, located at 478 Butler Road, Forest City, has an incredibly clean and safe environment where you get high-quality service at a great price. Peterson's was voted Rutherford County's best auto service 3 years in a row. So take your car to Peterson's for brakes, oil change, North Carolina inspection, tire rotation, headlight lens restoration, scratch removal, and meticulous auto detailing. That's Peterson's at 478 Butler Road, Forest City. You can call him for an appointment at 245-8889. Mention you heard Kimberly on WCAB 590 AM, and Peterson will give you $20 off a full detail or $5 off your next North Carolina inspection. Peterson's Auto Service and Detail Shop, a place I feel comfortable going to.
I want to welcome Tim Schlabach and Foothills Photo Works, a professional hybrid commercial photography studio. If you're concerned about your social media image, listen up. Whether you're an executive, real estate broker, lawyer, or business owner, your image matters now more than ever. And first impressions count. Whether you need professional portraits, corporate headshots, images of your products or facility, aerial photography, and videos of buildings, boats, or large acreage, affordable professional help is here for you. Foothills Photo Works can create media that will help your prospects get to know you better and help you look your best. Foothills Photo Works is located at 362 Charlotte Road in Rutherford, North Carolina, but you need to call for an appointment. That number is 828-668-2304. Mention this ad and receive 15% off your first session. That's 828-668-2304. Foothills Photo Works, your media professionals.
We are back. Gilbert Talks Taxes, WCAB 590 AM, because, I'm going to say it again, taxation with representation has not been such a good idea. There were several things I wanted to talk about. Those of you, I don't know which way to go right now, Todd. I've got to look at my time. I've got 20 minutes left. Those of you that are writing off business owners. This is business owners, or anybody that is using mileage, writing off your mileage. In 2017, the standard mileage rate from the IRS is 53.5 cents a mile. 53.5. This makes it real easy. Now, this is not you. If you're leasing your car, different rules, but you bought a vehicle, 100% business use, really even less than that, because you use your business vehicle. I mean, do you ever stop at Bilo to get milk on your way home? Technically, that's personal use. but most people will say it's 100% business use. Some people will break it out. They'll track their miles. You're supposed to be tracking your miles. Now, there are some third-party apps for those of you iPhone, Android users, smartphone users. There are some third-party apps that will track your mileage. You get in your car, it tracks where you went, especially if you're using a GPS, if you're in a business where you go to a lot of different locations and you're using Waze or you're using some of these other apps, third-party apps, you can track your mileage. Do that. And be aware. Now, what I would tell you to do at the end of the year, print that log. Again, don't just save it as a PDF somewhere. Because when the IRS comes a-knocking, all of a sudden people don't remember their name, let alone where they put things. And I tell people, print it. I'm getting back. This is my new thing. This is like, remember when Obamacare came out and I said how terrible it was going to be? Nobody listened to me, as Todd just reminded me. Nobody listened to you. Nobody did listen to me. They all thought it was going to be the best thing in the world. No, it was a terrible idea. Okay, so I'm telling you, I'm seeing it a lot. People think they can go back to their bank and just pull PDFs. Well, if the bank changes owners, the new owners may not keep the old archives. They don't have to. It falls on you. So I say at the end of the year, print it all. If you're going to put it in a PDF, fine. Burn it to a CD or a DVD, whatever your technology you're using, or stick it on a jump drive and put that jump drive away with your tax records. Really, jump drives are like a few dollars these days. They're almost like disposable. Just burn everything on a jump drive that you need if you want to be paperless and stick it. I think the whole paperless thing is overrated. I still use paper, I am paperless. I mean, I've got 409 gig of data stored in the cloud that I in a secure server that we pay a lot of money for. So we are all about being paperless as far as archiving. But for your personal stuff, you just put it in a box, put it away, label it, and after 7 years, get rid of it. I say keep it to 7 years, and just keep it. If when in audit, you just want to be able to walk up to it and grab it. And an audit could be, you could get a letter saying, we want to know about ABCD. ABC, we just want to know about it. And you just make copies of it and you send it. Let me give you a little tip too. If you're going to make a copy, never give the IRS originals, ever. Give the IRS originals of anything. They are not liable. There was actually a famous case where a man, the IRS came to his office, the lady wanted blah, 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 whatever. He gave her several boxes of documents, original documents. Being the frugal businessman he thought, well, this would cost a lot of money to copy, gave it to her. She took it back to her office and promptly lost it. They came back to him wanting these records. He said, I gave them to agent so-and-so. Well, agent so-and-so is not on your case anymore, and agent so-and-so doesn't know where the records are. This thing went all the way to tax court. And tax court, which, by the way, only 8% of the cases in tax court go in favor of the taxpayer. 92% go in favor of the IRS. So you've got a long row to hoe there, my friend. Do you want to keep it out of tax court? But in tax court, the judge ruled 92 to 8 are the odds, okay? Who did he rule with? He ruled with the IRS. He said it's the taxpayer's responsibility to keep records, and the taxpayer should have known better. Okay, so that ruling has now set a precedence. Actually, this happened years ago. It's been a precedence. But let me give you this tip. So the IRS comes knocking. Now, the first thing you should do is get representation. Don't talk to the IRS yourself. Call me. Call somebody. You need a tax attorney, a CPA, or an EA. Don't use a tax preparer. They're not authorized. And don't let your internal accountant talk to them. If you're in an audit, you need help. You can use an enrolled agent, a CPA, or a tax attorney. And I say tax attorney because you want an attorney that knows taxation. Not just any attorney can talk to the IRS. They think they can, but I've mopped up too many messes they've made. So let them talk to them. So they come, you're going to give them papers. This is the tip. Make 2 sets of copies of whatever you give the agent. Make a set, because now you know what they have in their file. You know now what you've given the IRS, because believe me, a month from now, who's going to remember? And then then you decide that you need professional help because this thing's exploded on you, and I come to your office and I say, what did you give the IRS? Everything. What do you mean everything? You didn't give them everything. Oh yeah, we make copies of everything. Well, what did you make copies of? Everything there. No, you didn't. You didn't, and you don't know. So I don't know what that agent has, which is very important if you're going to be negotiating, especially if they come back and say that you owe a lot of money. Well, what are you basing that on? So make 2 sets of copies and never, ever, ever let them go to your copier. You do it. You do it yourself. And don't ever, ever, ever let them take anything out of your office that's an original. Okay, so getting back to the mileage. So the mileage log, print that mileage log, because when the IRS wants to see it, they want to see it, and you don't want it on some phone somewhere that now you can't find it. And that mileage log. Now you can go back and recreate a mileage log if you don't have one based on other things. You'll have, other receipts of places you went or contracts that were signed or meetings that you had. So there's ways around it. So getting back to this, and we're going to take a break here in a minute. The mileage rate's 53.5 cents a mile. In that, what that is covering is fuel, maintenance, repairs, insurance, and depreciation. So you need to be aware when you trade that vehicle in, because you've got some depreciation there that needs to be recaptured. This is the time of the year I sit with people and we go over through their vehicles, people that have multiple vehicles for a business. What happened to the 2007 Dodge Ram pickup truck that you had? What happened to it? Oh, I got rid of that. I got a Ford. I'm a Ford man. Got a Ford. Really? What did you do with it? Sold it, I think. Maybe, I don't know. Gave it away. My son's driving it. They can't give me an answer. And this is important because if you sold it, we need to recapture some depreciation, and we could actually have a depreciation write-down, and it would create an additional business loss. You could be leaving some money on the table. On the other hand, you could recapture this depreciation and have to owe the government some money. But you're better off me finding it out than the auditor finding it out when they come and ask where these vehicles that you've been writing off are. So I'm just giving you a little caveat there to be aware of. Don't just think, we're just writing off 53.5 cents a mile and let's move on. We got to keep records of it, and I do keep records of it if you're my client. If you're doing this on your own, keep records of it, business owners. It could be a really nice write-off. It could be thousands of dollars of depreciation you can write off on, especially if you're trading in, because now the depreciation travels with the trade-in as the cost basis is adjusted. I know, I love talking about this stuff. Let's take our last break, Todd, and we'll come back. This is Gilbert Talks Taxes right here, WCAB 590 AM.
A good sign is good business. Make your business stand out with a professional sign from DS Signs and Graphics. Successful companies all over the Carolinas are trusting Alex at DS Signs and Graphics. He has the artistic ability to present your company's image in the best light. Not only display signs, but DS Signs and Graphics can customize banners of all sizes. And if you need magnetic signs or window and vehicle lettering, call on DS Signs and Graphics today. They offer a full line of signs and graphics for any event. 3D, sandblasted, storefront, and monument signs are part of the complete selection of quality signage. Professional signs and banners to fit any budget. Let your business stand out. Call DS Signs and Graphics today. That phone number is 286-4900. Or stop by the sign shop located on Main Street in downtown Spindale. And check the website for more suggestions at dssignsandgraphics.com. Suffering from numbness in your feet, leg cramping, pain when you walk, difficulty sleeping from leg and foot discomfort? Well, you need to see Dr. Jerry Gross at Foot and Ankle Center of the Carolinas. Your feet don't have to hurt. Call 245-6405 today.
We are back. This is Gilbert Talks Taxes. Now, if you need to get a hold of me, where can they get a hold of me, Todd? They can call me at 828 289-9300. They can email me, gilbert@gilbertcarmona.com. You can just stop by my office, 113 Whitesides Road, right next to Southern Baptist Church. That little tiny house is my office. A lot of information today, Todd. It's just flowing. It is just flowing. The temperature today, 53 degrees. It's beautiful, beautiful April 1st day. Another thing I'm seeing, there are people, and I don't know who put this out there. I don't know if this is just here in the county. What I see happen is a couple of CPAs will say something, monkey see, monkey do. One hears, one did it, and the other one will do it. And then people will run with it. Then the client comes to me because of whatever, they have a problem that they need solved. And I get referred to them, and I see these things. I say, well, who told you to do that? And they say, well, so-and-so years ago told me to do it. And the person may not even be in business anymore. They'll be retired. And I'm like, well, years ago might have been a good idea, but it ain't anymore. So let's start afresh. But what I see happen is people create an S Corp. They create a corporation. It could be an LLC. It could be a whatever. Remember, there are two business tax returns. There's an 1120, which is also an 1120S if you're an S Corp, if you've elected S Corp status, or there's a 1065, which is the partnership return. You got a partnership, you got a corporation, or you got an S Corporation. Whether you're an LLC or not doesn't matter for which tax return I'm preparing. There is no such thing as an LLC tax return. I ask people, what kind of business entity or what kind of tax return do you prepare? Oh, I prepare an LLC tax return. No, there is that. No. You can be an LLC and file Schedule C on your 1040 as a sole single member LLC, or a PLLC if you're a doctor or a professional and you qualify for that status. I'm talking about the actual tax return. So you've created whatever type of entity, you've created a corporation, an S Corp, and now you write yourself, you are the owner, and you write yourself a 1099 miscellaneous for the money you've taken. Somewhere this got put out there that this was a good idea. No, it's a bad idea. You are now paying an additional 15% tax because of doing that, because that 1099 miscellaneous now has to go on your 1040 as self-employment income. The whole reason we created a schedule, an S Corp, the whole reason you came to me if I did it was to reduce your tax burden, and I did that by creating a corporation, S Corping you. You are not going to pay the self-employment tax anymore. You are now going to get a K1. Yes, the K1 is smaller, but you have now created income. And writing yourself and giving yourself a W-2 is also a bad idea. It can be a bad idea. Let me say this. Giving yourself a 1099 miscellaneous is definitely a bad idea. Whoever said to do that, I don't know what tax strategy they were trying to do, but you now have totally defeated the purpose of S Corporation. You're back to being taxed as a sole proprietor. So if you're doing that, if you've done that, stop that. If you're in the middle of that, or if you have done that, you really need to see somebody else and have this reviewed, because you may be leaving money on the table, a lot of money. And what happens is, typically when a business is new, the thing is losing money, and you don't notice it because it's all negative the first year or two. Most of these businesses lose money, so nobody noticed it. Well, now the thing is making money. You're 6-7 years into it, and you're still doing this practice, and you are paying an additional 15.67% tax, which in my book is way too much. But then I feel any tax is way too much. That's beside the point. Another thing I'm seeing is the self-rental trap. You own a business, the typical scenario, you own a business and you need office space. So you buy a building and you rent the office space to yourself. Okay, it seems like a really good tax plan. You collect the rent, you depreciate the property, the business gets to deduct the rent. The money never really leaves your pocket, it's still your money. It seems like a win-win for everybody, right? And done right, it can be. Done right. But you need to know there are special rules that apply to self-rental, and make sure your self-rental arrangement works correctly tax-wise, because you can actually get burned on the other end and be paying more tax. And a lot of this stuff just seems good. See, you get into this whole topic, and this is another topic, Todd. You can buy a book on this too.
Is it $2,000?
It's fascinating. No, it's not $2,000, but it's pretty expensive. No, the other one was $2,200, and I think it was worth every penny. I'm sorry, but ground leases, I'd pay $2,000. Hardcover. Did I mention it was a two-volume hardcover, bound edition? Yeah, my wife didn't see the value of that. But that would have been a business write-off, by the way, for me. Even though it would have been good nighttime reading.
It'd be cool if you get it read by Morgan Freeman.
Really? Well, listen, if you're willing to pay $2,000, having Morgan Freeman read it as an ebook would not be that much of a stretch at that point. The problem lies with these self-rentals is that it's is it passive or non-passive? There's all kinds of rules that kick in for passive income versus non-passive income. Passive income, you can't write off a loss. It's passive. And I'm being general, okay? There's general thing here. Everybody's tax thing is specific. Anything I've said in this show, in this presentation of this 1 hour, is general guidelines and opinions. You really need to sit down and have your situation looked at. But if the self-rental produces a net income, the income is non-passive, and this destroys the hope of using the rental income to free up suspended passive losses. It also makes this income taxable. I know that's complicated what I just said, but if you're in this position, please give me a phone call, 828-289-9300. If you're doing this and you're wondering if you're doing it right, if you had this arrangement set up years ago, you may need it revisited. Or if you've got a tax accountant that you're using, have them look at it. If the self-rental produces a loss, that loss is passive. Often this suspends the loss and likely adds to other suspended losses. You can't write those losses off. You may not be able to. People assume you can, it's a loss, let's write it off. But sometimes you may not be able to write it off. And that's where you don't want the IRS to come back and look at this and say, oh no, wait a minute. Passive, non-passive, they'll get into all those questions with you. You'll fail the test, or you'll pass. Depends which side you're on. On their side of it, you pass the test, and now that is taxable, and they're going to go back, and they're going to get you, and you are now the victim of this. I see this a lot with medical practices. I see where the doctor will own the building, rent it, retailers, tire stores, just a lot of these businesses where the owners will own the land, the building, and they'll rent it to the business. They own both. So these can be complicated arrangements. You need to sit down and look at them. And if this is something you did 10 years ago and every year you just file your tax return, business as normal, rules have changed. Laws have changed. Nobody stops to look at these things. It's a busy time of the year. Your tax person is just moving through the motions, doing what they did last year, plugging in new numbers. You may want to revisit some of this stuff. You've never been audited. And I know the big thing right now that everybody is saying, got 30 seconds left, the big thing right now that everybody is saying is that the IRS, Donald Trump froze federal hiring. IRS staff is at an all-time low. Your chances of getting audited are the lowest they've ever been in 20 years or whatever. I keep seeing these emails cross my desk. I don't believe it for a minute. And they can go back 3 years in an audit, 7 years if they find something, forever if they suspect fraud. There's two things. When you come to me, you get this promise. I will try to reduce your tax liability legally the best I can, and I will try to minimize obvious audit risk legally. And that's what I try to do. And if you just go from one year to the next without revisiting these issues, you can't guarantee either. Okay, let's go ahead and stop there. Thank you for listening, everyone. This has been Gilbert Talks Taxes. If you need to get me, 828-289-9300. See you next Saturday.
Explosives into electronic devices. That information prompting the recent ban on electronics on overseas airlines. ABC's Gloria Riviera reports from Washington.
The Department of Homeland Security saying in a statement, evaluated intelligence indicates that terrorist groups continue to target commercial aviation. We use a robust security system that employs multiple layers of security, both seen and unseen.
The wife of a Tennessee teacher who allegedly kidnapped his teenage student now filing for divorce. It comes as the teacher and the girl were spotted shopping in a different state.
The first confirmed sighting of that Tennessee teacher and the student he allegedly kidnapped more than 2 weeks ago. 50-year-old Tad Cummins and 15-year-old Elizabeth Thomas seen on Walmart surveillance camera in Oklahoma City on March 15th.
ABC's Kana Whitworth reporting it was a winning streak that spanned 111 games. Last night, it ended.
William on the drive.